Welcome to this explainer. Today we're diving deep into Stephen Place's covered call trading, and honestly, we are going to completely transform how you approach the market. If you've ever felt like your portfolio is just constantly at the mercy of wild, unpredictable market swings, well, this analysis is going to give you a serious, measurable edge.
Look, let's start with a quick reality check right from the author himself. Trading really isn't about getting rich quick. It's about smart, systematic execution. You see, Stephen Plass is an engineer by trade, and he brings that exact mathematical, structured mindset to the financial markets. There are absolutely zero magic bullets here. In fact, as Place bluntly puts it, if you're looking for a secret formula to double your account in 3 months, you should probably just go ask Amazon for a refund.
So, here's our roadmap for today's explainer. 1. Trading for consistency. 2. Mastering options terminology. 3. Calculating your real returns. 4. The 6-step screening framework. 5. Real-world risk management. And finally, 6. The covered call lifecycle. Okay, let's jump right into Section 1, Trading for Consistency, and shatter the biggest illusion in retail investing today. Here's the thing. The secret to long-term survival in the stock market, it is definitely not about finding the next massive breakout or hitting these crazy financial home runs. A high win rate on wild speculations almost always ends in disaster. Why? Because as Place points out, trying to be too smart can actually really hurt your returns. Instead, we want to use strategies like covered calls to systemize our setups, drastically reduce our risk, and enhance our returns consistently. It's all about building a reliable income engine that works for you in almost any market condition. Moving on to Section 2, Mastering Options Terminology. Let's cut through all that confusing financial jargon so we can actually understand the mechanics of these trades. Options can definitely seem intimidating at first, but they really just boil down to a few core concepts. First up is premium. Whenever you sell a call option against stock you already own, you receive a premium. Think of it like this. The market is basically handing you cash up front to compensate you for taking on a legal obligation. Specifically, you're agreeing to sell your shares at a predetermined target, which we call the strike price, if the market happens to reach it. Next up, we have moneyness. This is super important. It tells us if an option is in the money, or ITM, meaning it actually holds intrinsic real-world value right now, or is it out of the money, OTM, where it's entirely reliant on time and hope. Basically, it's a quick measure of exactly how advantageous it is to use that specific contract based on where the underlying stock is currently trading. And this is a brilliant illustration of exactly how intrinsic value works in practice. Imagine today is options expiration day. You hold a call option that allows you to buy a stock at $50. Now, if the stock is currently trading at $45, you obviously wouldn't use it, right? But if the stock climbs to $55, wow, that option suddenly builds intrinsic value, because it's highly advantageous to exercise it. You literally get to buy a $55 asset for only $50. The option's value has to rise to reflect that exact mathematical difference. All right, Section 3, Calculating Your Real Returns. Let's take these concepts and see how they translate into the real world by calculating exactly how a covered call generates profit. We'll use the stock Freeport-McMoran for this example. First things first, we have to calculate our basis. Let's say you buy 100 shares of the stock at $36.78. You then sell a call option against those shares with a $37 strike price. And for doing that, you collect a premium of $1.20 per share. Now here is where the magic happens. By subtracting that $1.20 premium from your initial purchase price, you instantly lower your actual cost basis down to a much safer break-even point of $35.58. Next, you need to know your absolute maximum profit potential. To find this, you simply take that strike price of $37, which remember is the price you're obligated to sell at if the stock goes up, and you subtract your new, lower basis of $35.58. That leaves you with a maximum net return of $1.42 per share. Finally, we figure out what's called the return on basis, or ROB. We just divide our max return of 1.42 by our basis of 35.58, which reveals a very solid 3.9% return. This is an absolutely crucial, highly practical metric. By converting the raw dollar amount into a percentage, you can directly compare this potential 3.9% gain against entirely different stocks with completely different prices. That's how you decide if a trade is actually worth tying up your capital. Section 4, the 6-step screening framework. Okay, so the math clearly works, but how do we find the right stocks in the first place without accidentally stepping on a financial landmine? Place outlines a really vital 6-step framework to help retail investors avoid what he calls fat premium value traps. Listen, just because an option pays a huge premium doesn't mean it's a good trade. High premiums usually mean high risk. You must screen out ETFs, ensure the stock actually has options, demand high liquidity, and absolutely avoid companies with near-term earnings reports. Oh, and definitely screen out those volatile biotech hand grenades, unless, you prefer treating your portfolio like a weekend trip to Vegas. Finally, stick with the trend by ensuring the stock is trading above its 200-day simple moving average. Let the bigger market participants do the heavy lifting for you. Now, by applying these basic common sense filters in a free tool like the Finviz Screener, you immediately take a chaotic, completely overwhelming list of over 6,000 tickers and narrow it down to a highly curated, actionable list of maybe 600 stocks. Literally, this is how you systematically engineer your edge before you ever even place a trade. Moving on to Section 5, Real-World Risk Management. What's really fascinating here is how this systematic approach to risk can literally save you when the unthinkable happens out there in the real world. Let me give you a crazy example. In early 2011, Place identified a classic pullback to breakout setup on Cameco, which is a uranium mining stock. The idea was pretty straightforward. As it pulled back into previous resistance, it would find support and rally. So he executed a premium selling strategy right against it. But then, just a month later, the Fukushima earthquake and tsunami disaster struck Japan. It was a completely unprecedented, unpredictable black swan event that caused this uranium stock to absolutely plummet overnight. I mean, this is the absolute nightmare scenario for any trader. However, because Place rigorously calculated his basis and managed his risk up front, he actually survived it. The targeted return on basis for that initial setup was a very modest but highly defensible 1.5%. He wasn't swinging for the fences at all. He was engineering a calculated edge, and that structural discipline kept him completely grounded when the broader market turned to absolute chaos. It really just proves that knowing exactly where you are wrong is so much more important than just being right. And finally, Section 6, the covered call life cycle. Let's pull all of this together and look at the big picture of how you should actually be managing your active portfolio over time. Look, most amateur investors operate on an incredibly basic life cycle. You buy a stock, and then you just sit there and eventually hope to sell it for a profit. It's entirely linear, it's completely passive, and frankly, it leaves you highly exposed to the wild whims of the market. But as an educated covered call options trader, your life cycle map becomes highly dynamic. You buy the stock, sure, but then you might scale out by selling calls against a portion of your shares. You might decide to add to your position if the stock drops to a key support level, or you might just get stopped out entirely. The point is, you are constantly managing your exposure. You're generating continuous premium income and systematically reducing your cost basis along the way until your shares are finally called away at a profit. By deeply understanding your metrics like return on basis, screening ruthlessly to avoid those nasty value traps, and following a strict dynamic life cycle map, you can genuinely transform your portfolio from a game of chance into a consistent income engine. You really don't have to be a perfect market timer to succeed. So I'll leave you with this final thought. Knowing that a structured, mathematical approach can shield you from even the worst market disasters, what's stopping you from engineering your own edge in the market starting today?